There's a lot of speculation floating around as to what's going to happen over the next 6, 12, and 24 months. GDP growth in Q1 of 2022 fell short of expectations, declining by 1.5%. And if that trend continues, we'll officially be in a recession. But even if in hindsight the recession's officially backdated to later this year or early 2023, the writing's on the wall. The downturn has already started, and inflation isn't slowing down. We're staring down the barrel of dreaded stagflation. And it begs the question, as investors, how should you be preparing? And I'm going to cover all that and more in this video. What's up, everyone? It's Matt Marsh, founder of Marsh & Partners. Marsh & Partners is a development and national consulting firm that helps business owners and investors maximize their real estate and transform their businesses. Now, if you've been enjoying what we're doing here and want to keep seeing more content like this, please hit that like button, share this video and our other videos with people you think might find some value in them. So here's where we stand today. The stock market is in a bear market. Bitcoin is down over 30% the past month. Ethereum's down nearly 50% over the same time period. The Federal Reserve has hiked the Fed funds rate to 1.75%, with more hikes anticipated over the coming months. Inflation is at 40-year highs, and really it's much worse if the CPI was calculated the same way it was back in the 70s. And, to top it all off, new mortgage applications are at their lowest rate in over 22 years. So, all that's to say that we're treading on pretty tenuous waters right now, and the prospects for a quick economic recovery look bleak. I tell people, don't expect a soft landing on this one, especially since the Federal Reserve has spent the last decade and a half inflating what I call the everything bubble via historically low interest rates and record stimulus. But there are ways to prepare, and it begins by investing in real estate. But it's important to keep in mind that with these economic booms and bust cycles and peaks and troughs come different downturn and recovery stages, and they each require a different approach and different set of preparation. So in order to really dive into real estate investing during a recession, I'm going to break down the life cycle of a recession into two different time horizons, short-term and long-term. Because simply saying, quote unquote, invest in real estate isn't an adequate answer. So let's jump right in. So I want to be upfront about something. I don't see a way that the Federal Reserve can navigate a soft landing. The government's response to the last several recessions have only served to kick the can down the road. And now, even if the only solution was to pull a Volcker and raise the Fed funds rate to 20%, there's no political will to do it. So I'm coming at you from that lens. The lens of someone who has always taken a little bit of a contrarian approach to finance and politics. Academics will tell you, since World War II, recessions have ranged anywhere from 6 to 18 months, averaging 11 months. And while that's technically true, the negative consequences of recessions are felt much longer. And this one will last longer than 11 months. I can almost assure you that. In fact, one of the reasons we're suffering from such a crippling housing shortage problem right now is because of the underdevelopment of homes since the Great Recession. Now, I should also tell you that I'm not going to come at you with the boilerplate wealth management spiel, wealth manager spiel either. You don't need to hear that you need to pay down your credit card debt, or that you need 6 to 12 months of expenses in a reserve account. If those things haven't happened already, they probably won't before the recession, and you don't need to hear them. But over the next 2 to 3 years, however, certain types of real estate and the right investment approach can actually help you weather the storm. So let's first discuss leverage and liquidity, because there are two schools of thought on this. Leverage during a recession could be a scary thing. Anyone heavily invested in real estate during 08-09 knows that those certified letters come fast and furious, and they don't stop. But conversely, debt, especially during times of inflation, can be a powerful asset. As the rate of inflation exceeds the nominal rate of interest on a note, the real borrowing rate is negative. And if you believe the US dollar will come out the other side of this much weaker than it was going in, taking on debt today to invest in assets like real estate and cryptocurrencies may be practical. But leverage also plays into the concept of liquidity. It's wise to keep as much cash on hand to navigate whatever changing circumstances may occur over the next couple of years. That could be to take advantage of buying opportunities that will surely present themselves over the short term, or just for peace of mind. And financing acquisitions with some debt can help preserve some of your liquidity. Ultimately, you'll want to consider recapitalizing your portfolio to achieve a more optimal debt and equity blend for current assets and any planned acquisitions. But what about finding the bottom of the market? If you have some extra cash on hand, you'll obviously want to deploy it at the right time. Now, conventional wisdom says that you shouldn't try to time the market, and that's true. But history gives us some insight into how real estate markets evolve during recessions, which can help you better prepare to make smarter timing decisions. If we look historically, the first stage of a recession in the real estate market is signaled by a period of price discovery. Buyers and sellers need to wade through the obfuscation that's clouding their expectations. Lenders evaluate their loan portfolios and ready their playbooks while the market takes 6 to 12 months to establish a new baseline for pricing guidance. The next 1 to 2 years are when the real opportunities present themselves. Property owners, they'll look to get out from under failing assets, and lenders will look to rid themselves of bad debt. But here's where this downturn is going to look a little bit different. Real estate returns over the short-term recession will be largely location-driven. We've already seen it over the last couple of years with the Great Migration. But certain metros have completely outpaced the majority of the country in population and rent growth and asset valuations. People flock to where the opportunities are, right? Or they move to where they might experience a little bit more freedom than they would have otherwise. But that means that it will also be important to reevaluate your real estate strategy. As asset prices have ballooned and investors have looked for places to put their money, many have resorted to investing in properties with the singular hope of capturing value appreciation. But that strategy leaves you exposed, especially if the property's underlying cash flow doesn't justify the purchase price. Cash flow deals are hard to find, but they're still out there. And over the next couple of years, they'll begin to present themselves as the market cleanses itself of the malinvestment we've experienced over the last decade and looks to return to some semblance of equilibrium. Now, the last thing you need to consider as you prepare your real estate investing strategy over the short term is product type. I already mentioned that the US is suffering from substantial housing shortage as a result from underbuilding over the last decade. That's a fact that policymakers are rushing to combat. But what's also a fact is that people need a place to live. So it begs the question, what type of real estate does well during a recession? Well, let's again turn to historical data to inform our decision making. If we look across the last several recessions, apartments and multifamily properties have almost always outperformed alternative investment vehicles. But that's not to say that every multifamily investment's the same. Luxury, Class A apartments are generally less resistant to downturns than Class B or Class C alternatives. And as interest rates rise and home ownership becomes less affordable for a larger swath of the population, many resort to renting. And the short supply of affordable rental options in many markets leave apartments as the only option. But what about industrial real estate? After all, it buoyed the real estate market during the downturn of 2020. Well, it looks like the shine is coming off that apple a little bit as well, especially with some of the larger bulk Class A industrial space. But well-positioned, higher margin, and smaller, more agile industrial properties in key markets will remain an excellent investment. Single-family property investments are also worth consideration. Just as rising interest rates turn potential home buyers into apartment renters, they too turn buyers into home renters. Consider too that developers and home builders may begin to pull back from their frenzied building pace the last 2 years, which will further exacerbate the affordability and supply challenges we're presently facing. Rental properties in markets sustained by population in-migration and job growth are historically good inflation and recession-resistant investments. Recessions inevitably create unease, but they're often looked at as fantastic buying opportunities. A lot of life-changing wealth is made during downturns with a sound and prudent strategy. It's also worth mentioning the wealth effect when we talk about real estate's long-term trends resulting from a recession. As households become poor, at least on paper, because of depreciation in stock, bond, and cryptocurrency values, they'll begin to pull back on their spending habits. Not only may they be less inclined to take vacations or go out to eat, but many households look to cut their monthly mortgage or rental payments if possible. And that means that more families turn to entry-level real estate options, like starter homes or more affordable apartments as they look to live more within their means. But this further cements the opportunity that well-positioned real estate in the right market offers for investors. But the most important long-term trend we need to consider is the effect of inflation. Let's assume that the Federal Reserve gets inflation under control over the next 12 to 24 months through rate hikes or whatever other tools they have at their disposal to plunge the economy into a recession. And that's a huge assumption, one that I'm not inclined to believe will be the case, but bear with me. Once we come out the other side of this period of high inflation, we're going to transition into a more prolonged period of mild, steady inflation or secular inflation. And that secular inflation spells good things for natural inflation hedges over the next 10 to 20 years. Think gold, real estate, and in some circles crypto, especially if you believe the era of the dollar's dominance is nearing its end. I should also note too that most of the world is living in a country with a currency that is experiencing rapid inflation, while historically it's typically hovered about 20% of the global population. And that means that more and more investors are going to turn to alternative forms of sound money and asset-backed investments to preserve their buying power. But what does that mean ultimately? Well, it means a higher demand for real estate and rising asset prices over the long term. Now, as we navigate these next couple of years, it's critical to view your real estate strategy through the lens of both a short and long-term time horizon. Optimize your portfolio in the short term by investing in historically recession-resistant types of real estate, deleveraging, and freeing up some cash if necessary, and identifying your target markets carefully. Also keep in mind what rising interest rates will do to real estate over the short term and how that volatility may impact the value of your portfolio near term. But once we make the transition into the post-recession economy and settle in before the next boom-bust cycle, real estate's poised to be an important part of that conversation. Now, if you're concerned and want to talk about strategies, we might be able to help. We also have investment opportunities in some of our ground-up development projects, as well as some acquisitions here in the Raleigh, North Carolina market. You can reach out if you want to learn more about any of those. And please, if you enjoyed this video, hit the like button, subscribe to our channel, stay up to date on content to help you through your real estate investing and development journeys. You can also check out our website for more real estate insights at marsh-partners.com. Feel free, leave me a comment if there are any other topics you're interested in or you'd like me to cover specifically. And again, don't forget to subscribe if you want more content like this, and thanks again for watching.